There is a $15 trillion window open right now, but it won't stay open forever. The greatest wealth transfer of our generation is unfolding right now, and most people are watching it happen from the sidelines. Artificial intelligence isn't just another technology cycle. It's a complete restructuring of how value is created, how businesses operate, and how fortunes are built. And unlike previous revolutions, this one is moving at unprecedented speed. In this video, I'll reveal the top 5 AI ETFs that have the potential to create the fastest and smartest path to building wealth in the stock market, with confidence, simplicity, and momentum. The first ETF owns the companies that make artificial intelligence physically possible. The second ETF is unique for its intelligent diversification that helps mitigate market fluctuations. The third ETF completely eradicates the problem of identifying a single dominant quantum computing stock because it provides you with a basket full of them. The fourth and fifth are designed to capture long-term innovation across the US and global technology landscape. And at the end, I will show you and Bobby my top 3 from these 5 AI ETFs and demonstrate their 10, 20, and 30-year portfolio projections. And one in particular that can transform a one-time investment of $50,000 into a whopping $6 million. Listen, folks, the fortunes being built right now aren't coming from luck. They're coming from strategic positioning before the mainstream catches up. McKinsey forecasts AI will inject $15.7 trillion into the global economy by 2030. Goldman Sachs calls it the most important platform shift since the internet. This isn't hype. It's a reality backed by adoption data, infrastructure spending, and accelerating integration across every major industry. Here's what that means for your money. Imagine Bobby and his friend each invest $130,000 in January 2025. His friend decides to play it safe with the S&P 500 and earns a respectable 22%. Ending the year with $158,000. Bobby, on the other hand, decided to allocate that same capital to a top-performing AI ETF, which delivers between 35 to 40% returns. Bobby's year-end balance, $180,000. That's over $20,000 more from the exact same initial investment in the same time frame, with zero additional effort. You don't need to spend nights researching individual stocks. No gambling on unproven startups. No trying to time perfect entry points. Just intelligent allocation that rides the wave of the most transformative economic shift since the internet. The question isn't whether AI will dominate the next decade, it's whether you'll be positioned to profit from it. Welcome to Investments Mindset, where wealth builders come to get inspired. Before we continue, please note that we are not financial advisors. The content on this channel is for educational and informational purposes only. It is not intended to provide investment advice or recommendations regarding specific securities or investments. Always conduct your own research or consult a qualified financial professional before making any investment decision. Every investment involves risk. Let's dive in. Claiming the first spot on our list is the VanEck Semiconductor ETF, ticker symbol SMH. This unique ETF is one of the clearest ways to invest directly in the AI boom because it owns the companies that make artificial intelligence physically possible. It has consistently stood out by focusing on the industry's most dominant players rather than spreading capital across dozens of marginal names. Nearly 20% of the fund is allocated to NVIDIA, the undisputed leader in AI computing. NVIDIA controls roughly 92% of the data center GPU market, and its Blackwell chips are already booked at full capacity through 2026, signaling powerful and sustained demand. As long as execution remains strong, analysts continue to see meaningful upside ahead. Beyond NVIDIA, SMH gains strength from exposure across the entire chip supply chain. Taiwan Semiconductor anchors advanced manufacturing. ASML provides the irreplaceable lithography technology required to produce cutting-edge chips, and AMD continues to gain share in high-performance computing. Analyst forecasts pointing to double and even triple-digit upside in several of these companies help explain why SMH's performance has been so exceptional. The fund trades with strong liquidity, averaging about 1.6 million shares per day, and carries a reasonable 0.35% expense ratio. While SMH holds just 26 companies, that concentration is intentional. These are the highest quality semiconductor businesses in the world, and the results reflect it. Over the past year, the fund is up roughly 39%. Over 3 years, it has surged more than 177%. Over 5 years, SMH has compounded at an average annual rate of about 29%. AI's influence now extends into biotechnology, automation, and advanced manufacturing, and SMH sits at the center of that expansion. For investors seeking high-conviction exposure to the infrastructure powering AI's growth, SMH remains a compelling long-term play. Securing the second spot on our list is the Global X Artificial Intelligence and Technology ETF, ticker symbol AIQ. This isn't just another tech ETF. It represents direct ownership in the AI transformation, reshaping the global economy in real time. This unique ETF is built with a focused mission, capturing the rapid, compounding growth of artificial intelligence as it expands across nearly every major industry. What sets AIQ apart is its intelligent diversification. Rather than concentrating returns and risk into a few mega-cap names, the fund spreads exposure across the entire AI ecosystem. Information technology remains the core, but AIQ also reaches into communication services and consumer discretionary sectors, where artificial intelligence is already redefining how companies operate, compete, and scale. This structure allows investors to benefit from AI's momentum without being tied to the success or failure of a single stock. The portfolio highlights how deeply AI is embedded in today's economy. Netflix leverages AI to drive engagement through advanced content recommendations. Meta is investing heavily in AI infrastructure to support the next generation of digital interaction. Salesforce is transforming enterprise software with generative AI tools that improve productivity and decision-making. No single holding dominates the fund, helping reduce volatility while preserving upside. Performance reinforces the thesis. AIQ delivered a 24.6% gain last year and has generated average annual returns of roughly 17% over the past 5 years, while maintaining strong technical buy ratings. Trading just over $52 per share, it remains accessible for long-term investors. Although the 0.68% expense ratio is higher than basic index funds, it reflects active exposure to a fast-moving, high-growth sector. AIQ offers diversified access to AI's growth engine at a critical moment, capturing both today's leaders and tomorrow's breakthroughs. Before we continue, if you find value in this video, even just a little, please subscribe and hit the like button to help us continue to provide more insightful and educational videos. Your support is highly appreciated. Thank you. Claiming the third spot on our list is the Defiance Quantum and AI ETF, ticker symbol QTUM. This unique ETF represents the next frontier beyond today's AI boom by targeting the companies developing the computing power that will eventually redefine what artificial intelligence can achieve. While traditional chips have driven the current wave of innovation, quantum computing is designed to solve problems far beyond the reach of classical systems, and Q2M gives investors early access to that shift. This ETF focuses on the builders of the AI age's future infrastructure, positioning investors ahead of the curve rather than chasing what's already fully priced in. With exposure to specialized leaders such as D-Wave and other quantum-focused innovators, QTUM offers rare access to pure-play companies operating at the cutting edge of science and engineering. These firms are laying the groundwork for breakthroughs in cryptography, materials, science, and advanced AI training. At a current price around $116, the fund has already shown strong momentum, posting a gain of over 46.23% over the past year, as investor interest in quantum technology accelerates. QTUM's expense ratio of 0.4% is reasonable for such a niche and technically complex area, where active selection and thoughtful weighting matter. Launched in 2018, the fund is still relatively young, but its 73 holdings provide meaningful diversification across the quantum computing ecosystem, helping reduce the risk of betting on a single winner in an uncertain and rapidly evolving space. Choosing one company that will dominate quantum computing is extremely difficult, even for experts. QTUM solves that problem by spreading exposure across the companies actually building the tools that will power next-generation AI. Claiming the fourth spot on our list is the Invesco PHLX Semiconductor ETF, ticker symbol SOXQ. This special ETF represents the foundation layer of the entire AI revolution because, without semiconductors, none of this technology would exist. This unique ETF tracks the 30 largest US-listed companies involved in chip design, manufacturing, and distribution, giving investors direct exposure to the engines powering AI, cloud computing, autonomous vehicles, smartphones, and virtually every modern electronic system. Memory chips, microprocessors, integrated circuits, and advanced manufacturing equipment are not optional in today's digital economy. They are mission critical. SOXQ is a pure-play expression of that reality. The fund is 100% technology-focused, with top holdings including NVIDIA, Broadcom, Advanced Micro Devices, Marvell Technology, Taiwan Semiconductor, and ASML. Each of these companies occupies a vital position in the semiconductor supply chain, from chip design and fabrication to the highly specialized equipment required to manufacture at cutting-edge nodes. Trading at a current price around $54, SOXQ has delivered solid long-term results, gaining 52.83% over the past 5 years. While the one-year return of roughly 11.65% may appear modest compared to explosive AI rallies, that performance reflects recent volatility in semiconductors, particularly following heavy concentration in names like NVIDIA. The 1% expense ratio is higher than that of broad market ETFs, but SOXQ is not a broad market product. You're paying for concentrated exposure to the most strategically important industry of the AI era. Instead of trying to guess which single chipmaker will dominate, SOXQ allows investors to own the backbone of AI itself, while spreading risk across the entire semiconductor landscape. Rounding out the fifth spot on our list is the iShares US Tech Independence Focused ETF, ticker symbol IETC. This distinctive ETF adds balance and depth to an AI-focused portfolio by shifting the emphasis away from pure hardware toward the software and services that actually drive profit. The iShares US Tech Independence Focused ETF is designed to capture long-term innovation across the US technology landscape, and its performance clearly supports that goal. Over the past 5 years, the fund is up an impressive 155%, with gains of more than 30% over the last year alone, all while maintaining a relatively low expense ratio of just 0.8% for this category. While technology dominates the sector allocation, IETC's real strength becomes evident when you look beneath the surface. Unlike many AI-focused ETFs that are heavily concentrated in semiconductors and hardware manufacturers, IETC leans strongly into software and services. This internal diversification within technology makes this extraordinary ETF a powerful complement to more hardware-heavy funds. For investors who already hold exposure to companies like NVIDIA or Taiwan Semiconductor through other ETFs, IETC helps reduce overlap while keeping portfolios firmly positioned in the broader AI ecosystem. It captures the application layer of AI rather than only the tools used to build it. The fund's holdings reflect this strategy, featuring companies that drive productivity, automation, analytics, and digital transformation across industries. These businesses benefit not only from AI breakthroughs, but also from long-term trends such as cloud adoption, enterprise modernization, and data-driven decision-making. IETC stands out as a strategic, long-term technology ETF, built for durable growth, rather than short-term hype. Now, I do not believe investing in any of these 5 AI ETFs is a mistake, because they are all solid funds. However, based on my research, my top 3 are QTUM, SOXQ, and IETC. To prove my point, I will demonstrate their 10, 20, and 30-year projections using the compound interest formula, also known as the future value formula. The formula calculates future value by multiplying your initial investment by the growth factor over time. This is the breakdown. FV represents future value. PV represents present value or initial investment. R represents the annual growth rate as a decimal, and N is the number of years the investment grows. The formula calculates future value by multiplying your initial investment by the growth factor over time. Now, let's dive into the numbers for QTUM. This investment calculation demonstrates what can happen when Bobby invests $50,000 in the Defiance Quantum ETF, ticker symbol QTUM, and allows it to compound over time without making any additional contributions. The fund has demonstrated a 5-year annualized share price appreciation of 22.6%, indicating the average annual growth in the share price. When you include the effect of reinvested dividends, the actual compound annual growth rate is 10%, which is a more sustainable and conservative figure for long-term financial projections. To calculate the future value, we use a lump sum formula. We take the initial investment of $50,000 and multiply it by 1 plus the growth rate raised to the power of the number of years we're projecting into the future. In this case, 10, 20, and 30 years. To determine the value of R in the formula, the compound annual growth rate of 10% is expressed in decimal form. To convert a percentage to decimal format for mathematical calculations, you divide by 100. So 10% divided by 100 equals 0.1. In the future value formula, we use 1 plus the growth rate, which means we add 1 to 0.1, resulting in 1.1. This 1.1 represents the total value after 1 year of growth, where 1 is your original investment staying intact, and 0.1 is the additional 10% gain. For the 10-year projection, we multiply $50,000 by 1.10 raised to the 10th power, which calculates to 2.5937, resulting in a future value of $129,685. This shows that Bobby's investment would grow by approximately $79,685 over the first decade, more than doubling his original principal. Looking at the 20-year time frame, we use the same methodology but raise 1.10 to the 20th power, yielding 6.7275. Multiplying this factor by Bobby's initial $50,000 produces a future value of $336,375, demonstrating that his investment would increase more than 6-fold over 2 decades. The 30-year projection becomes even more compelling, where raising 1.10 to the 30th power gives us 17.4494, and when multiplied by Bobby's starting investment of $50,000, results in $872,470. This illustrates the remarkable impact of compound interest working in Bobby's favor over an extended period, where each year's growth builds upon not only his original investment, but also all the gains accumulated in previous years, potentially transforming his $50,000 initial investment into nearly $900,000 after 3 decades. Next is SOXQ. Let's check out the projections if Bobby invests $50,000 in this unique ETF and lets it grow over time without adding any extra funds. The fund has recorded a 5-year annualized share price appreciation of 29.6%, reflecting the average annual increase in the stock price alone. However, when you account for reinvested dividends and the complete total return picture, the actual compound annual growth rate is 10.06%. To calculate the future value, we use a lump sum formula. We take the initial investment of $50,000 and multiply it by 1, plus the growth rate raised to the power of the number of years we're projecting into the future, which in this case is 10, 20, and 30 years. To determine the value of R, we first convert the compound annual growth rate of 10.09% into decimal format by dividing it by 100, which gives us 0.1009. Next, we apply the formula component that requires adding 1 to the growth rate. So, we calculate 1 plus 0.1009, which equals 1.1009. This 1.1009 represents the total value after 1 year of growth, where 1 is your original investment staying intact, and 0.1009 is the additional 10.09% gain. Now, let's dive into the 10-year projection. First, we multiply $50,000 by 1.1009 raised to the 10th power, which equals 2.6084, giving us a future value of $130,420. This means Bobby's investment would grow by approximately $80,420 over the first 10 years, more than doubling and slightly outperforming a standard 10% growth rate due to that extra 0.09% in the compound annual growth rate. When we extend the projection to 20 years, we raise 1.1009 to the 20th power, which produces 6.8037. Multiplying this factor by your original $50,000 results in a future value of $340,185, showing that Bobby's investment could potentially grow nearly sevenfold over 2 decades. Next is the 30-year projection, which reveals even more dramatic growth potential, where raising 1.1009 to the 30th power yields 17.7480. And when we multiply that by Bobby's initial $50,000 investment, we arrive at $887,400. This showcases the extraordinary power of compound growth, working over an extended time horizon, where your money grows exponentially as each year's gains generate their own returns on top of all previous growth, potentially converting Bobby's $50,000 initial investment into nearly $900,000 after 3 decades. Claiming the top spot on our list is iShares US Tech Independence Focused ETF, ticker symbol IETC. This calculation demonstrates what happens when Bobby invests $50,000 in this exceptional ETF and allows it to compound over time without making any additional contributions. The fund has shown a 5-year annualized share price appreciation of 11%, which represents the average annual increase in the stock price. Interestingly, when you factor in reinvested dividends and the complete total return picture, the actual compound annual growth rate jumps significantly to 17.24%, indicating that this fund has generated substantial returns through dividends and distributions on top of its share price gains. To calculate the future value, we'll still use the same lump sum future value formula. We take the initial investment of $50,000 and multiply it by 1 plus the growth rate raised to the power of the number of years we're projecting into the future. In this case, 10, 20, and 30 years. To determine the value of R, we first convert the compound annual growth rate of 17.24% into decimal format by dividing it by 100. Which gives us 0.1724. Next, we apply the formula component that requires adding 1 to the growth rate. So, we calculate 1 plus 0.1724, which equals 1.1724. This 1.1724 represents the total value after 1 year of growth, where 1 is your original investment staying intact, and 0.1724 is the additional 17.24% gain. For the 10-year projection, we multiply $50,000 by 1.1724 raised to the 10th power, which equals 5.0273, resulting in a future value of $251,365. This demonstrates that Bobby's investment could potentially grow by approximately $201,365 over the first decade, increasing more than 5-fold, and significantly outperforming most other investment options due to that robust 17.24% compound annual growth rate. Now, for the 20-year time frame, we apply the same calculation method, but this time we raise 1.1724 to the 20th power, which yields an impressive 25.2737. When we multiply this factor by Bobby's original $50,000, we get a future value of $1,263,685, showing that his investment could potentially grow more than 25 times its original value over 2 decades. Remarkable? You bet. But check out the 30-year projection. For this, we raise 1.1724 to the 30th power, which yields 127.0938. And multiplying that by his starting investment of $50,000 results in an extraordinary $6,354,690. This illustrates the almost unbelievable power of high-rate compound growth over an extended period. Think about that for a second. Potentially transforming a one-time investment of $50,000 into over $6 million after 3 decades. And there you have it. The top 5 AI ETFs that can transform your portfolio from average to exceptional. The risk isn't in acting boldly, it's in hesitating while others secure their position. Currently, some skeptics claim the AI bubble is ready to pop, but I believe they're making the same mistake people made in 1999, dismissing the internet. Most enterprises haven't even begun large-scale AI deployment. We're not at the end of this cycle. We're at the beginning of the infrastructure build-out, the regulatory framework development, and the enterprise integration phase. Just as smartphones took years to reshape society, AI will too, except faster and with far greater economic impact. Please share your thoughts and plan in the comments section below. We would like to hear from you. If you're serious about building real wealth, then consider this channel your financial gym. Every video is a workout for your portfolio, your mindset, and your money skills. If today's video helped you level up your financial education, even just a little, please smash that like button and subscribe so we can continue to grow and build wealth the smart way. Please note that we are not financial advisors. The content on this channel is for educational and informational purposes only. It is not intended to provide investment advice or recommendations regarding specific securities or investments. Always conduct your own research or consult a qualified financial professional before making any investment decision. Every investment involves risk. Click on the next video on your screen. Thank you, my friend.